Hi everyone, and welcome back to a brand new episode. My name is Marcus and I'll be your host. In today's episode, we're going to take a look at Tesla. If you're new to this channel, welcome. What we do here is that we study and analyze stocks. We go through the fundamentals and the technical analysis of the stock, but we also talk about finance and investing. And if you've been here before, thank you so much for coming back. I truly hope you guys will enjoy this episode, and please give me a thumbs up, comment, subscribe, and let me know what you think, but also what stocks you want me to take a look at. Thank you so much. Now let's get started. As I mentioned, we're going to take a look at Tesla, and if we go down to the screen, we can tell that they are traded on NASDAQ and they're in the manufacturing sector, and their market capitalization is at $758 billion, and their revenues were $41.9 billion, and the PE ratio is at 399. Guys, you know that I like to take a look at companies with a PE ratio of 20 or below. Having a PE ratio of 399, that is extremely high. This tells me that there is a lot of hype behind the growth, this stock growth. It tells you when you see a PE ratio that is high, it tells you that the market expectation is high on the stock, and their overhanging risk is that if the company doesn't meet those expectations, we will see the stock price fall. So having a PE ratio of 399, that is just too high, so it's a no for me. The profit margin is at 5%. I like to take a look at companies with a profit margin of 15% or higher. So having a profit margin of 5%, that is a no for me. And their price to sales ratio is at 20. Guys, I like to take a look at companies with a price to sales ratio of maximum 2, and having 20, that is just too high. So that is a no for me. Now, the price to book value is at 30. I like to take a look at companies with a price to book value of maximum 3. So having 30, that is just way too high. So that is a no for me. So if we summarize, the price to earnings is too high, the profit margin is too low, and the price to sales ratio is too high, and the price to book value is too high. This tells me that the company is overvalued, and we need to see the stock price fall in order for it to become more attractive. Now, they don't pay out any dividend, which is a shame. I like the dividend income. Now, the return on equity is at 12%. I like it. Basically, return on equity tells you as an investor about the company's ability to create return on the invested equity. And especially for a company that doesn't pay out any dividends, it's critical that you take a look at return on equity and see if the company is able to create a return on the capital that you invest in them. So having 12%, I like it. So that is a go. Now, return on assets is at 4%, a bit low, but still positive. I like it. So return on assets, that is a go. I like it. Now, they are currently traded at $755 per share. If we take a look at the 50-day moving average, we can tell that we are trading above it, but also above the 200-day moving average. This is a clear signal that we might see the stock price go even higher. And we can tell here, if we take a quick glance on the chart, that we're trading higher in a channel, and we are right now on the upper levels of the channel, and if the indicator is correct, then we might see price move even higher towards the resistance level. But we'll take a closer look at the technical analysis as we go on. Now let's move over to the income statement, and what we can tell by the look at the income statement, that the total revenue went from $7 billion in 2016 up to $31.5 billion in 2020, and has been growing steadily every year. I like it. The gross profit went from $1.6 billion up to $6 billion, and also has been growing steadily every year. I like it. Now, the net income did a loss for 4 years they did a loss, and then last year in 2020 they made a net income of $721 million. I like it, and we can tell that their number has been improving every year, so I like it. Now let's move over to the balance sheet. And what we are interested here is that the current assets versus the current liabilities, and we can tell that the current assets is greater than the current liabilities, which is a plus. I like it. Basically, it tells you that if the company were to convert the current assets to cash, they're able to pay off their current liabilities. Now, they're not able to pay off their total liability, but it's not far from it. So that is a minus. I would like to see them be able to pay off their total liabilities. Now, the total liabilities went from $16.8 billion up to $28.4 billion. It has been growing every year. That is a minus. I want to see the company lower their total liabilities. If we jump over to the outstanding share, we can see that we went from 161 million outstanding shares, and we're growing every year. And then the last year in 2020, we jumped from 181 million outstanding shares to 960 million outstanding shares. That is a minus, and that is a huge jump, going from 181 million to 960 million outstanding shares. Basically, as for an investor, you want to keep an eye on the number of outstanding shares, because when you see the outstanding shares increase, that means that your part or your share of the company is decreasing because there are more and more outstanding shares, and that's a way for a company to bring in more capital to the business. For instance, and there's a lot of investors that miss this because they'd be looking at the total liabilities. For example, they'll see a company that the total liability is not growing that much, the balance sheet looks great, but the company is, instead of taking on more debt, they are putting out more shares in order to bring in more capital. So be cautious here. The more outstanding shares, your share of the company is decreasing. So they are increasing, so that is a minus. Now let's move over to the cash flow. And what we are interested here is that the operating cash flow, and we can see here went from negative 123 million down to negative 61 million, and then has been improving over the last 3 years. I like it, so that is a plus. And also we can see that the difference, which is we are interested, the difference between the operating cash flow and the capital expenditure, and we can see we went from difference 5.9 minus $3.2 billion. There's a huge leg room. I like it, and we can see the numbers has been improving for the last couple of years. I like it. Now let's move over to the key figures, and what we can see here, the earnings per share went from negative $4 to 75 cents, and we fell off 1 year, but then the last 3 years we have been improving the numbers. I like it. Revenue per share went from $43 per share down to $32 per share, and we increased 1 year, and then we increased a couple of years, but the last one we fell off. But overall, I'm liking the trend, so this is positive. Equity per share went from $29 down to $23. We fell off 1 year, but then we got back up, and then so it's a bit of fluctuation here. I don't like fluctuation because that is hard to determine the future of the company. But overall, they are improving, so I like this. This is a positive. No dividend. And we understand, looking at the numbers, they shouldn't be paying out dividends, but it's a shame. I like those dividends, but in this case they shouldn't be paying out any dividends. Now profitability, the gross margin went from 22% down to 21%, and has been falling ever since. That is a minus. I would like to see the gross margin increase, but we can also tell that in 2020 the gross margin was 21%. Now imagine the cost of goods sold, and you have to also, you cannot just say, okay, the sold a product for $1 gets to keep 21%. We have to take a look at the industry, overall industry. How is other companies doing it? But still, being able to keep just 21%, the cost of goods sold is too high, but I would like to see the company improve their gross margin, so that is a negative, and their operating margin went from 9% up to 3%, and we can see here we fell off 1 year, but for the last 3 years the numbers have been improving. I like it. The profit margin went from 9% up to 2%. As we saw previously, we fell off 1 year, but for the last 3 years the numbers have been improving. I like it. Return on equity went from negative 14% up to 3%, and the trend is the same. We fell off 1 year, but for the last 3 years the numbers have been improving. I like it. Return on equity basically tells you as an investor about the company's ability to create return on the invested equity, especially for a company that doesn't pay out any dividends. You want to make sure that the company is able to create a return on the capital that you invest in them. So 3%, that is very low, but I still like the trend that they are improving year after year, so that is a positive. Return on assets went from negative 2.9% up to 1.3%, and this trend is the same. We fell off 1 year, but for the last 3 years the numbers have been improving. I like it. Solidity went from 20% down up to 42%. We fell off 1 year, but for the last 3 years the numbers have been improving. I like it. Solidity basically tells you about how much of the total assets is financed by the equity. Also gives you a picture of the company's financial strength for the short term, and seeing that the numbers is improving. I like it. Balance sheet liquidity went from 0.7 up to 3.8, and we fell off 1 year, but for the last 3 years the number have been improving. I like it. Balance sheet liquidity, looking at same thing as solidity, but here it looks at the company's financial strength for the long term, and seeing that the numbers is improving. I like it. So that is a plus. Now debt ratio went from 3.5 down to 1.2, and we increased the debt ratio 1 year, but for the last 3 years the numbers have been falling. I like it. Basically it tells you that the last year that they had a debt ratio 1.2 means that they have 1.2 times more debt than equity, and seeing that the number is getting lower and lower. I like it. So that is a positive. Now guys, we have gone through the income statement, the balance sheet, the cash flow, the key figures, and now over to a key feature of our software, and that is the pillars. And basically what the pillar does is that it gives you an overview of the company's performance. Everything we have gone through, it gives you in just one slide everything, that is easy to digest. So if you want to dig through the numbers, you can dig through the numbers, but if you just want to have a quick glance of the performance, the pillars is the right tool for you. So if we summarize, we can see that the PE ratio is above 20, which is negative. They don't pay out any dividends, which is negative, but in this case they shouldn't be paying out any dividends. Now the number of outstanding shares have increased, that is a negative. The revenue increased over the past 5 years, that is a positive. Profit margin below 15%, negative. Profit increased over the past 5 years, that is a positive. Current assets greater than the current liabilities, that is a plus. Solidity increased over the past 5 years, that is a plus. Balance sheet liquidity increased over the past 5 years, that is a plus. And debt equity ratio decreased over the past 5 years, that is a plus. And total liabilities have increased over the past 5 years, that is a minus. Guys, as you can tell, it gives you a simplified, easy to digest overview of the company's performance, and it saves you a lot of time. And you can have this tool along with everything we've gone through for only $25 per month, and you also get access to our analysis page where we publish more articles and videos for you to enjoy, and you also get to be able to chat with me alongside all of the members. So join today for only $25 per month. This tool is right for you and it's yours to have. Now let's jump over to the technical analysis of the stock. So here we have the chart. Let me just lay down the lines here. Here we have the support line, And let me see here, the resistance line, we have something like that. Let me change the color to red, and as we can tell, we are trading higher. We have higher lows and higher highs, but as we can tell that we are trading up in a positive trend line here. But also we can be very cautious here, because if we we can lay down another resistance level, resistance line over here, and we saw that the price is trading above the 50 and 200 day moving average, basically indicating that we might see price move even higher and to the resistance level. Now, if we are to be very cautious, because we can see that the resistance holds here, and here, indicating that this is a strong resistance level. So we might see price move even lower towards the support line, and that's where I would trade the stock, because afterward we could see first a move of 13%. That is not a huge trade, but still a positive trade. But if you get in on those levels and you hold the stock for a long time, you could see price move upwards 38-40%. Now that is a trade to make. So that's what I would do, because looking at the historic data, we see that the resistance line here is very strong and it might hold. We might also see a breakout, but if we do see a breakout, what I will do is I'll wait for the price to go up and then fall back down towards what used to be a support line, a resistance line, and then if the price moves even high and breaks above the previous high, then that's a signal to buy. But looking at the chart right here, I can tell that the resistance line is very strong, that we might see price move towards the resistance line and then push even lower towards the support line, and that's where I would trade the stock. Now guys, how would you trade the stock? Please let me know in the comments box below. And that's it for this episode, guys. Thank you so much for watching. I truly hope you have enjoyed this episode, and please give me a thumbs up, comment, subscribe, and let me know what you think, also what stocks you want me to take a look at. Thank you so much. Now guys, till next time, take care. Bye bye.